Mike, talk to me about your price target with the 33.50 and the pressure on that, even as some of the other bears have capitulated a little bit. Tobias Levkovich of Citigroup, David Kostin of Goldman Sachs. What are you seeing that other bulls aren't seeing?
Well, what I would say is that, while our call, this year was well-timed in March and April to get aggressive, we've been surprised, quite frankly, at just how fast not only the recovery has occurred, but the stock market itself has responded to that. And that's our bull case. So our bull case is 3,700 by, June of next year. And it's looking more likely that that's going to become our base case. This is not an exact science. That upside case is going to be driven by earnings growth. That's been our view, right? The revaluation of the stock market has already happened, right? The Fed has acted swiftly. Rates have come down and multiples have expanded. People have complained about that, saying, well, it doesn't really reflect reality. But that's the way it always happens, Taylor, in a recession, right? Multiples expand as earnings come down because the market knows that that's the trough. And 2021 is going to be a good year for earnings growth. And quite frankly, it's looking like it may even be better than what most people are thinking. And that's where we think people could be surprised next year on the upside. The earnings growth is better than what they're anticipating.
And it's earnings growth, and you also mentioned the Fed. And as you know more than anyone in that discount dividend model, it is that little r, the rate at which you're discounting future earnings, inflates that present value, all thanks to the Fed. How much, though, of that bull case scenario, which increasingly is looking like a base case scenario of 3,700, is really dependent on rates at zero?
Yeah, it's a great question. And it's been, like I said before, this has been the main driver of the rally so far since March. It's been a revaluation, right? Equity risk premium is compressed, rates have stayed low, and that means multiples can expand. We think 90 to 95% of that is over, meaning it's very unlikely in our view, if our scenario for V-shaped economic recovery plays out, then it's very unlikely that 10-year yields are going to go to new lows from where we've been already. We think, in fact, that the more likely outcome is that 10-year yields rise. And that could actually put pressure on multiples in the short term if that were to happen over the next 2 or 3 months. But then we think the earnings is what's going to surprise on the upside, which is what drives the market next year. So I wouldn't be surprised if we stall out here in the near term as, we get comfortable with the recovery, the stimulus comes through, we get past the election, rates are able to rise, earnings come in, but multiples compress. And then next year is really an earnings story, and that drives the upside in the target that we've talked about a minute ago.